then I'll carry it on. All right, so okay, if you happen to have any technical issue that you couldn't hear me or you couldn't see the slide or what, do drop it in the chat box as well. Then we will help to fix the issue. All right, next, I would like to introduce our speaker. We have two speakers today. The first speaker will be Encik Wan. Encik Wan, he's the head of research and chief economist in AmBank Berhad. Encik Wan, he has over 18 years of experience in the financial industry, comprising of macroeconomic and financial market research, fund management, as well as corporate credit ratings. So he holds a Bachelor in Economics Finance from the International Islamic University, Malaysia. So between 2004 and 2006, he started his career in Bank Negara Malaysia as a financial market analyst and fixed income portfolio management for International Reserve Fund. And he then joined Malaysian rating corporate Berhad as a head of fixed income research. Then he pursued his career to MNRB Holding Berhad in 2012 as the head of research and chief economist. So in 2018, he joined General Insurance Berhad as the head of investment, and now he has transferred to AmBank Berhad as the head of research and chief economist. The next speaker will be Mr. Alex Goh, which is our head of equities research in Investment Bank Berhad. He was the former head of investor relation in AmBank Berhad Holdings. He has been involved in equities research since 1996 in multiple sectors, such as, you see the list there. So he was involved in covering banking, conglomerates, plantation, consumer, manufacturing, construction, gaming, utilities, energy, oil and gas, as well as telecommunications. Okay. So without further ado, I'll pass my mic to the first speaker of the day, Encik Wan. Encik Wan.
Hi. Thanks, MC, for kind introduction. Allow me to share my screen. Okay. Now, good afternoon, everyone. It's a lunch hour, so let's try to make it as subtle as possible. By the way, my name is Wan. I'm coming from AmBank side. My colleague Alex is from Investment side. So just to differentiate, my coverage is more on the economic research, whereas Alex covers equity research. So without further ado, let's go to the nature of the presentation today. So I'm going to talk about on the macroeconomic perspective in terms of the most recent budget retabling. So let's have a look at it. It's kind of growth supporting budget in my point of view. It's about 19 billion higher than the amount that was announced in October last year. So it kind of implies a good thing in the sense that expenditures is going to be higher than what was previously announced. So in terms of government revenue, we are looking at 9292 billion, which creates a shortfall of 93.9 billion. And then this shortfall is expected to be financed by the government bond market. So another good thing about this budget is that we notice people-friendly measures such as cash assistance amounting to 8 billion was retained, 1 billion being injected to EPF, and a tax cut for M40. So we believe that all these measures are going to propel domestic demand in light of the global external headwinds that is expected to take place this year. So there are two key new measures announced in terms of enhancing revenue on the government's part, which is the announcement of the introduction of a luxury tax as well as capital gain tax on disposal of unlisted shares. Now, at this stage, we do not have anything to pretty much comment about this thing because we're still waiting for more information flow concerning these two factors. Another thing that we think is kind of positive to domestic capital market from this budget is that there wasn't any announcement on the prosperity tax, which should help corporation in the sense that if you can recall, we have had this prosperity tax announced previously, but there is no such thing. So that should boost confidence in the capital market. I think Alex is going to talk more about the investment side. Now, on the next page, as I mentioned earlier, government bond market will be tapped to finance this deficit, but it's not a new thing because every year the country has been tapping the sovereign debt market as far as financing of its deficit is concerned. So in that sense, we are looking at government bond issuance of 175 billion expected for this year to finance that deficit as well as refinancing of incoming maturities. Now the question is, can this amount be absorbed? I think the answer is yes, thanks to our deep capital market, because we have a lot of institutional players in our domestic capital market, and pretty much all of them are having exposure in the bond. So we believe that it can be absorbed by the local market. Now, sometimes not all debts are bad. What I'm trying to say here is that if you notice for this year in this budget, the good thing is that the development expenditure is quite high. It is about 97 billion. So raising debt to finance the development expenditure is, in my point of view, is okay in the sense that you are basically financing the future growth of the economy. Now, the fourth point to share there is about our sovereign rating. We expect the sovereign rating of Malaysia by credit rating agencies, namely Fitch, Moody's, and S&P, is going to be retained and reaffirmed with a stable rating outlook. Now, if you can look at the bottom left there, one good thing about this year is that our budget deficit is envisaged to be lower. We were running at a deficit of 5.6%. Now for this year, it is estimated to narrow further to 5%, which means that the situation has gotten better and better since the last economic recession that we experienced in 2020 that was driven by the pandemic lockdown. Now, on the next page, if you can, Okay, now these are the key highlights for consumers, businesses, and there are pretty much good measures to allocate it for Sabah and Sarawak. I think I started this session just now by sharing how the good thing in the sense that cash assistance be retained. There was 8 billion there. 500 ringgit injection to EPF account 1. There'll be special assistance to civil servants and that 2% income tax reduction. And another thing is that there are also some goodies for SMEs. Now, we all know that SMEs is pretty much important in the context of the Malaysian economy because I think SME makes up about 37% of the Malaysian economy. So certainly they have a role to play. And if you notice there, the bullet point number 3, RM10 billion of SME loan by Bank Negara, which is this is kind of growth supportive in the sense that it provides cash flow. It sustains credit flow to SMEs to continue to grow their business as well as helping them to recover from 2020 pandemic-driven recession. Now, in terms of the cash assistance, we estimate that it would add around 0.5 percentage point to overall GDP. Just want to share with you, if you look at the bottom left chart down there, we are pretty much a consumption-driven economy, because actual number as at 2022, our private consumption size stood at 908 billion ringgit. Now, for this year, we are looking at 6.1% growth in the level of private consumption, and certainly these direct cash assistance measures delivered to the people would help to propel domestic spending. Now, this is another aspect of the thing that that we believe that we need to pay close attention, because recall that there is a multi-tiered levy system on foreign workers. So again, we are still waiting for new guidance in terms of more information flow to be delivered on this thing, because as you can see on the top left there, we have about in Malaysia we have about 2.1 million of foreign workers. So any increase in levy involving them would translate into higher costs to the corporate side who hires foreign workers. So the question is, what we need to monitor going forward is that at our end, we just want to see what sort of impact to the P&L of corporations who are exposed to foreign workers, if there is any margin erosion, or if there is any cost pass-through to the consumers. Because if there is a cost pass-through, then it would add a little bit of pressure to domestic inflation. So selected sectoral assessment, I'm giving a very macro viewpoint on the selected sectors. Financial services, we see these measures to help retaining the stable outlook for the sector. We have the 10 billion of loan funds from BNM that I pretty much mentioned just now, and the guarantee from SJPP. So that would help the financial services sector, particularly across the SME segment. Electric vehicles, I think this is the issue, the story of today. I believe you have heard that the government is making really a serious effort in terms of promoting EV going forward, because I think environmental friendly activities is very much welcome these days. I mean, people are talking about ESG, embracing ESG in their day-to-day operations. So we believe that measures to promote EV is one of the factors that would help the country towards achieving its net zero emission by 2050. On the construction side, there were a couple of announcements. The biggest one, of course, we all now know that MRT3 will be continued with a slight reduction in cost from original estimate of 50.3 billion to 45 billion. But apart from that, there wasn't any new mega project, but at least I think this should also benefit the small contractors in that sense. As far as oil and gas is concerned, I think we were looking at $80 to $90 in terms of global oil price. In terms of plantation, we're looking at the average palm oil price forecast of 3,500 ringgit per ton. So that's roughly on the assessment on the sector. A little bit on the growth. How do we then translate all these measures into expected GDP growth? Now, for this year, we are looking at the Malaysian economy to grow at the rate of 4.5% as compared to 8.7% registered in 2022. So what will be the growth driver for this year? We are looking at persistent job market recovery. To put this into perspective, our unemployment rate now is hovering around 3.5%, which is way better than the peak that we saw during the lockdown last time. I think our unemployment rate was above 5%. Now that with the economic reopening, with measures to support the economy, we noticed that unemployment rate had fallen to as low as 3.5%. So we believe this is going to support domestic demand in the Malaysian economy. Then we also have the realization of approved investments, because we have a major investment ongoing, such as ECRL, 5 the digital network kind of development. So these are the things that's going to propel the Malaysian economy this year, hence supportive of this growth expectation of 4.5%. Number three, China's reopening. I think we view that as a positive point in terms of promoting growth to domestic demand, in the sense that it would promote continuous recovery across the tourism sector. Now, for the benefit of just to share that, right before the pandemic, Malaysia has been receiving around 20 over million in terms of number of tourist arrival, of which around 12% of them made up by tourists from China. The thing with tourists from China is that their spending power, their purchasing power is very huge. I mean, it's not so difficult during, if you can recall, during pre-pandemic days, if you go to any shopping mall, we can see the kind of pattern that they had spent. Is really implied that they really have the purchasing power. So now that they are allowed to travel, it's a matter of them arriving here again in Malaysia to create more excitement, hence promoting domestic demand further. And then number four, we also believe that interest rate level here in Malaysia, by the way, it currently stands at 2.75%, is still accommodative. When I say this is accommodative, let's try to compare it against countries like the US, the Eurozone, the UK. All of those major countries have saw their interest rate rising by around 3 to 4%. As far as Malaysia is concerned, our interest rate had only risen by just 1%. So I believe that the level is still accommodative enough to promote domestic demand. But nevertheless, there are also some downside factors where we continue to monitor going forward. We know that the global economy is not doing so good, so that might affect the international trades. And we also know that at the same time, the United States, the US, is still not done with its interest rate hike. So the question is, where do they stop, or to what level do they bring their interest rate higher? Because the higher the interest rate goes up over there, it adds more, a little bit of pressure to emerging economies like us, in the sense that it will pose the risk on the currency. So in conclusion, we see a strength in the Malaysian economy. We had a robust domestic demand. We do not see any recession here in Malaysia. Our banking system is well capitalized. We have a accommodative monetary policy. We just had a conclusion of GE15. We're having stable sovereign rating outlook, and there is also no recession expected across ASEAN and China. Now, ASEAN and China is pretty much important because our trade with these two regions stands at around 40%. So it kind of helps if these two areas grow, because it will also be supportive of our overseas shipment. So in terms of growth support, we see retail, tourism, F&B, and malls are going to be recovered and to take advantage from China's reopening. Oil and gas, we see Petronas capex reaching around 40 to 45 billion for this year. Manufacturing aspect, Malaysia is expected to continue to be a hub for E&E. And item number 4, if you can see the EV, I pretty much had explained earlier how the government is pretty much becoming more and more focused in promoting EV in terms of its ecosystem as well. Now, the right side is just a point to share where I mentioned earlier, realization of existing investments. So these are the 4 things that we believe in terms of infra project that are going to assist the growing process of the Malaysian economy for this year. I think I've come to the end of my session here.
Okay, thank you, Encik Wan.
Okay.
All right. I saw there's one question on the chat box from Kai Xuan. He was asking, or she was asking, with the fiscal budget deficit, seems like we are moving towards expansionary policy. Do you think it will cause more inflationary pressure in Malaysia?
Okay, thank you for the question. If allow me to repeat the question, is the effect of the inflationary pressure from expansionary fiscal policy. I think one thing that is pretty much unique here in Malaysia is that we all know there is a huge amount spent on subsidies. So subsidies is pretty much helping all of us here Malaysian to avoid paying high price. Now, if assuming that subsidy expenses continue, then inflation is likely to be manageable. But nevertheless, at the same time, we have also heard the cases being brought up in terms of targeted subsidy, or in some extreme cases, some people are talking about removing that subsidy. Now, if that subsidies are being removed, then the answer to that question is yes, it may add to some inflationary pressure. That would be my answer to that question.
Thank you, Encik Wan. There's another question from Steven Young. He was asking, what's your view on inflation for second half, having an assumption of slowdown?
Okay, now for inflation, our baseline view as of now is 3% for the whole year. That's in comparison to 3.3% that the economy registered last year. And already we have noticed our headline inflation as of January coming down from a peak of 4% to just 3.7%. So we are seeing the declining or decaying pattern of inflation, largely due to easing of the global commodity prices. Now, going forward into the second half, I'm going to have to impose a certain assumption there. Now, if there is no cut in subsidy, then we expect inflation in the second half to continue to go lower. But nevertheless, if there is any subsidy rationalization, then there may be a case for inflation to increase. So the point here is this: the outlook for the second half really depends on what's going to transpire across these subsidy fronts.
Thank you, Encik Wan.
Most welcome.
There's no more questions being posted on the chat box. We can proceed next to Mr. Alex first, and then if there's any other questions, guys, please feel free to drop it on the chat box. We can still answer to your questions after Alex's session. Alex, over to you.
Okay, thanks, Joey. Thanks everyone for joining. Can you see my screen, Joey?
Yes, we can.
Okay, thanks. All right. Okay. These the slides that I presented to the institutional investors like EPF, PNB, and QAP. Right. So let me run through the slides, and thanks very much, Encik Wan, for the presentation on the budget. And what I'm going to do is I'm going to give the equity market outlook. What's the impact of the budget on the equity side, right? But for us to even start to talk about it, let's talk about what our forecast first, so that we can all be talking from the same page. Otherwise, we'll be talking about different numbers, and it's very difficult to carry the conversation. All right. So the first slide here, what I'm showing you is what is our projection compared against consensus. And these are the numbers that we've taken from Bloomberg, right? In terms of global projections for this year, we are not very far off from what consensus is looking at. We are looking at about 2%, right? For US, we are looking US GDP growth. We are looking at 1%, right? Higher than the consensus, looking at 0.7%. But that means even consensus is looking at a slowdown, right? Not a recession. I'll talk about Europe later on in the next slide, right? In terms of the federal funds trend, right? We are of course looking at higher rates, right? Moving forward, moving towards 4.75. That means at least another 25 basis point going forward, right? For Malaysia, right? Consensus is looking at only 4%, right? But for AmBank, one is looking at 4.5%, right? That is a slowdown, of course, from 8.8% in 2022, right? Now, for in terms of the CPI, right? In terms of inflation, we are looking at 3% for the full year, right? It's slightly slower than last year, right? Last year it is about 3.2%. For OPR, we are looking at another 25 basis point hike in the first half of this year, right, to 3%, right? Consensus is looking at another 2 more rate hikes, right, to 3.25, right? But for 1 he's looking at one more rate hike for the first half, and that will be the case for the rest of the year. And for the ringgit, and that is very important as far as where foreign equity flows are concerned, right? The base case is that one is looking at 420 to 430, right, by the end of this year. From where the ringgit currently is almost at 4.5 now currently, right? Now, based upon these top line numbers in terms of the economy, right, we expect the first half to continue to be very volatile given the potential for a widening negative carry trade. Currently, it makes more sense to put money in US, where you can get 4% interest rate compared to here in Malaysia, less than 3%, right? So there is a negative carry trade, right? And that explains the weakness of the currency, right? And on top of that, there is continued concern of a global recession, or especially in Europe, right? So because of that, there will be a lot of volatility. But as we move towards the second half of the year, we do expect a change in the trajectory, all right, where we think recessionary concerns will turn the US Fed rates, turn US federal rate hikes to the other direction. That means that they will start to look to cut, right, because of a slowing economic growth. And because of that, we think the negative carry trade will narrow, and that will bring about the higher Malaysian currency. And with that being the case, we are looking at FPM KLCI target of 1630, right? The ringgit now is only, the KLCI index now only 1450, right? So there is a lot of upside going forward, all right? And this is based on one standard deviation below the 5-year median of 16.3, right? And this one standard deviation, right? And it's based on a FY 2024 PE, right? That means looking, as we stand at the end of 2023, we'll be looking 1 year forward into 2024, right? And as I mentioned, we are looking at improving ringgit is one thing, right? And on top of that, Malaysia's GDP growth of 4.5% is definitely better than global growth outlook, right? Which is about 2%. It's more than double that. And on top of that, it's also much better than what the US GDP growth will be, right? 0.7 to 1%. Now, on top of that, in Malaysia, we have a calmer political climate. Last year was a lot of unprecedented that have taken place, right? And we had a situation where there was a parliamentary hung parliament, right? In other words, and that has never happened before in all of Malaysia. And on top of that, there was a situation where Perikatan could have come into power, right? And if you look at what past manifesto mentions in the Green Book, their Buku Hijau, you know, it could have caused a lot of turmoil for Malaysian financial markets, right? But be that as it may, right, we now have a unity government, and that is going to bring a lot more political stability, and we do not expect a Sheraton 2.0, right? And I'll explain why later, right? And that will bring valuations closer towards what we call the median valuations, all right? And the next slides will show that. The worst case outlook that we're looking at, right, is 2 standard deviation below the 5-year median, and that will bring us to 1415. We are not very far from where the current index, not very far from that, right? But why are we taking a 2 standard deviation? Because back in 2020, when the COVID-19 pandemic broke out, that was where the index headed. It went all the way down to 1300, and that was 2 standard deviation below the earnings, below its median back then, right? So that's why we are using that as the worst case scenario. And our best case, right, is taking 0.5 standard deviation below the 5-year median, right? So that will bring us 1740, right, index target, right? But our base case for now is 1630. Right. Now, this slide, right, is telling you what we have imputed into our base case, worst case, and the best case scenario, right? Given the time constraints, I just want to talk a bit more. I will choose only a few, right? The first that you see on top, of course, that there are risks that a persistently high inflation rate will cause interest rates to go to continue into the second half of this year. That means there is no rate change direction, right? So that is our worst case, right? If that's the worst case, yes, we will be looking at 14, 15 at the end of the year, right? But we see that as a low medium at the moment, right? Because all the noises we're hearing from the Fed is that inflation is still high and job market is still very strong, right? But there's a lot of noises. But as we move past the first half, I think there will be a bit more clarity there. But in our base case, we are not seeing that, right? We do expect the interest rate trajectory to change. The other thing to look at is will there be severe recession in Europe? Yes, that's very high for Europe. I think for UK, yes, there's most likely a case of recession because of high gas prices, right? For US, there is a medium risk, right? But that is not in our base case. Is there a risk that the US government, which is now politically divided with a slim Republican Congress, would they prevent the raising of a debt ceiling? And that would heighten default risk, and it could spill over globally. Now, if something like this were to happen where they are not able to service their debt, it would trigger a global meltdown. If you look at the global financial markets, markets back in 2008, right, when there was a meltdown because of Lehman Brothers bankruptcy, that was just a junk bonds, a private debt issue. But if it was a sovereign country that defaults, it would trigger a much worse meltdown, right? But that is not in our base case, right? The other thing I wanted to highlight is, would there be a risk that China will invade Taiwan and trigger another type of global trade sanctions? We don't see that, not even in our worst case scenario. If that will happen, I think that the worst case will be even worse. It will be much better. It will be a lot worse because, as what Taiwan mentioned, Asia accounts for about 40% of trade with Malaysia, right? And that would have I would have to relook at our target if that were to take place. For domestic risk, right? I mentioned earlier, what is the chances that there will be a discord within the unity government and that could lead to a Sheraton 2.0, a dissolution, right? What happened back in 2020 was something that was unprecedented. And I think that has put a lot of concerns that something like that can be repeated. But in our view, we don't think that is likely. Firstly, because Tun is no longer in power, right? And for something like that to take place, it has to be engineered right from the top, right? And given the fact that Anwar now has almost 2/3, actually he has 2/3 majority, even if there were some from Barisan were to pull out, right, he would still be able to retain his majority, right? So we don't see that in this case, right? The other thing to highlight, of course, that would there be reintroduction of prosperity tax or GST? Well, the recent budget announcement as indicated that is not the case, right? That's basically some of the factors that we've baked it into our base case outlooks, all right? So what will drive the IPM KLCI to 1630, all right? If you look on our left chart, you will see that the 10-year US Treasury and 3-month US Treasuries, 3-month bonds, they are not bonds, actually, they are yields, they are money market, right? They've inverted. In other words, the short-term rates are actually higher than long-term rates, right? So in cases like this, it has always signaled an imminent recession. And the past 3 incidents are, and actually much longer than that, it has indicated that US federal, the federal bank, they will they will cut rates, right, when there's a possibility of a recession, right? So that's why we have baked in a rate hike coming towards the fourth quarter of this year. And if you look in terms of my second slide here, I've compared our 3-month LIBOR against the 3-month US interest rates, the yields, right? It has also showed that there is a negative carry trade currently, right? And it looks like it's going to widen, right? But as you mentioned, as you enter into the second half, when the US federal rate hike starts to turn, right, that will support a stronger ringgit, right? So with a stronger ringgit, a more stabilized Malaysian political climate, all right, we will see equity valuations move towards normalization. Now, what is normalization? The next slides will show that, right? But all in, right, there are 4 things that will drive the market. First, relatively stronger GDP growth, and also stronger earnings growth expectation. 2, alleviating supply chain disruptions. Back in 2021, 2022, there was all the talk was the disruptions of trade because China had closed down, right? But with China reopening and because of a strong saving rates in China, right, the economic rebound that we saw in Malaysia last year, we are expecting that to happen to China, and that will pull the entire region up. And as what you mentioned, Asia accounts for 40% of Malaysia's exports, right? And then we expect a return of foreign equity investors with a stronger ringgit outlook, right? And of course, we have a relatively attractive valuations when we compare to the region, right? Now, this slide here is just showing you the foreign flow trends, the net foreign flow trends since October last year, right? Foreign flows has turned from net buying to net selling, right? And in fact, in February, right, the amount of foreign selling has actually slowed down. They have actually halved from January. So you can see that the negative number here seems to be slowing down, right? And in terms of foreign shareholding in Malaysia, right, we are now at 20.4%, right? They are somewhere near the bottom, right? And we think that this is probably near the base, a low base, or where foreign investors have been positioning themselves, right? So going forward, we think, right, there's only upside going forward. Right? Now, this is the slide that shows you the relationship between net foreign equity flows and our local institutional flows, right? Between the two, there is a 90% inverted correlation. Basically, when foreign institutions are selling, our local institutions are buying, right? So they are actually in reverse. But when you combine the two, the local institution and foreign institutional flows together, right, you find that both of them have been negative, and that explains why the market has been depressed over the past 3 to 4 years, right? And yeah, so when the situation changes, when net foreign equity flows and net foreign local institutions turn around, the market tends to do a lot better. In terms of net foreign flows in the region, right? Last year, foreign flows had actually turned positive. Look at Malaysia, right? We had actually turned positive. Where if you compare in the previous 4 years, they were all in a negative territory, right? But last year, right, we were actually 4.4 billion net positive, right? In fact, in August last year, up to August last year, right, foreign purchasing went up to 8 billion, right? But October onwards, they turned negative, so that 8 billion dropped down by half to 4.4 billion, right? So this little bar here would have been longer, but it actually halved, right, because of foreign flows going out in October, right? All in, right, Malaysia accounted for about 10% of last year's foreign inflows. And this year, in this region, Southeast Asia, right, which includes Vietnam, Indonesia, and Thailand, right, we are in a negative territory, right? Both of us, Malaysia and Southeast Asia. Right. So in terms of valuation, all right, where are we now, right? This chart shows our valuation compared to the 5-year median, right? If you to take the median range, Malaysia's valuation now is 1.7 standard deviation below the 5-year median, right? And I've done this chart for the rest of the region as well, so that we can do some comparison, right? In terms of time, we'll move faster. This chart shows Malaysia's performance, right? Against since the beginning of this year, like basically January and February, right? Malaysia is in negative territory, right? Compared to Japan and Hong Kong, right? Even China has done better, right? If you were to look at this side on the right-hand side, right, you can see that in terms of where we stand in terms of standard deviation against the 5-year median, right? Malaysia, right, is in a much deeper red territory compared to the region, right? That means valuation-wise, we are a lot cheaper compared to where we used to stand 5 years over a 5-year period. Right. If you look in terms of weighting, what sectors will pull our KLCI upwards, right? Banks and oil and gas account for more than half of the weighting, right? And those two sectors alone account for, and it's an overweight call for us, all right? And if you include all the other stocks in all the other sectors involved, right, they account for 70% of the FBM KLCI, all right? This part here, right, shows you in table form Malaysia's valuation against the region, right? In terms of earnings growth, we are looking at 19% jump in earnings for this financial year. Because of last year, there was a prosperity tax impact, right? So there's a 19% jump, right, in earnings for this year. If you compare with Indonesia, it's 6%, Philippines 10%, Thailand 13%. So in terms of Southeast Asia, Malaysia's growth is looking a lot more attractive, right? And you look in 2024, right? Yes, we are going to slow down a little bit compared to the region, but this year we are a lot more impressive, right? And in terms of our PE, we are looking at 13 times PE, right? In the past, if you've been tracking Malaysia, right, we used to be trading about 16 times, right? So there is a lot of distance for us to cover, right? And in terms of dividend yield, 4.5%, right? So with this table alone, it can show you that we are actually trading currently at a very attractive valuation, all right, and a pretty decent growth as well, right? So the sectors that we like, right? We like well, banks, of course, we like because given the high rating they have on the FBN KLCI and also the liquidity, right? That we expect another 25 basis point rate hike. That will be positive for the net interest margin for banks, right? At least for the 3 to 6 months. But on top of that, we are looking at 4.5% GDP growth. That will pull bank loan growth, all right? And on top of that, the tapering of MGS yields will mean an improvement in trading income for the banks, right? And the valuations of most banks are actually very attractive, right? Maybank actually offers you 7% dividend yield currently, right? I mean, for the largest bank in Malaysia, offering you 7% dividend yield. If you compare with EPF, it's giving you 5%, right? Yeah, I think you can see the contrast there, right? For other sectors like autos, we like them because we still see healthy daily orders in terms of the demand over the past 3 years during the pandemic period, right? A lot more people have joined the job market, right? And because of, even though there's an improvement in terms of infrastructure, right? People still need cars to travel to work, right? So because of that, we are seeing a lot of sales, right? And because of the supply chain disruption last year, there will be more models that will be launched this year, and that will pull demand further up going this year, right? So we like Burma's Auto, MBM Resources, and UMW, right? For companies, for oil and gas, all right, of course, oil and gas now at 80 to 90 dollars per barrel, right? That is at elevated prices, right, compared to the past, and that is still going to pull up a lot of services, right? Support services for Petronas, and given the prolonged supply disruptions and past underinvestment, right? That would mean we expect a more robust spending by all majors, right? I know there is an energy transition that's going to take place, but that will take a long time, right? Because the world is still largely driven by oil and gas in terms of provision of energy. We are one of the few investment houses that are positive on property. Yes, secondary market is still very soft, but we are looking at very strong demand in the primary market, right? Especially for affordable homes. You know, the past 3 years has been a very quiet time, right? And a lot of people have joined the job market, and there is a lot of pent-up demand for affordable homes, especially for companies like Marsing, even Legenda. We are seeing very strong pipeline of unbilled orders, right? That will provide earnings visibility. We also like REITs, of course. Many of the REITs that we have are providing between 7 to 10% dividend yield, right? And given the fact that the recovery and opening of the borders, it will mean better footfalls, and that also these malls are able to take advantage of the tenant share of sales, right? So there's a potential of of improving earnings outlook that would mean even better higher yields going forward, right? So we have buys, right? I know these are not the kind of stocks that most remisers look at, but these are the stocks that our institutionals like EPF and EPNB will be looking at, right? Like we like CIMB. Most of the banks we like, right? CIMB, RHB, right? Even Bank Islam, right? We have buy calls on them. We do like Tenaga Nasional. Yes, Tenaga's shares have been bashed down, all right, because of some of the ESG concerns, and also because of of higher receivables. But basically, their earnings is actually protected under the IBR's mechanism, right, where the internal rate of return of 7.3% is protected, right, under the EC's guidelines. For telcos, we are neutral, given the fact that the digital national, rollout of 5G remains clouded. But given Telecom Malaysia's network, where they control basically the fiber optic, right, and that is needed for 5G rollout, right? And with that, I think their earnings is actually quite stable, right? In terms of the wholesale earnings. For oil and gas, we like Yinson. Right? They are a prominent FPSO player, right? And there's limited number of FPSO players currently with the kind of balance sheet that is able to take on the kind of projects that is in the pipeline, right? So Yinson is one of those few that's proven themselves to be able to do that, right? And also we do like some pharmaceuticals like Duo Pharma, right? There's a rising demand for generic drugs in Malaysia, and also there's what we call a patent cliff. Many medicine that is under patent, they are will no longer be covered by patent, right, between 2022 and 2026. And because of that, all these new generic drugs, biosimilars, will be coming into play. But Duo Pharma has a very strong R&D, right, and manufacturing facilities to take advantage of it. Then, and also there's always a strong demand for vitamin C, right, given the COVID-19 and also all kinds of flu, influenza that's taking place. There's a strong demand for vitamin C, and their brands are Champs and Flavets, all right. And I'm sure you go to any pharmacy, you'll find them, the brand there. Yeah. So those are our top buys. We do have small cap ideas, but these small cap ideas are also not, I know, the kind of stocks that normally retail would look at, but they are below the one. Some of them are below 1.5, right? And some of them are about a few hundred million. We like Lee Suicat, we like Gilliam, we like Spitzer. These are very niche players within their own industry, right? And basically that is my view on the sector. So we are opening up now for question and answers.
Thank you, Alex. We do have some questions in the chat box. Okay, let me read it out. We have the first question from Steven Yong. Malaysia equity market returns has not really been attractive since 5 years ago. Any take from you since it's not convincing at all? And he also commented that I think assumption of recession, hence rate cut, could be really dangerous this time around if inflation is still high.
Okay. First of all, you're right. The Malaysian equity market has not been attractive over the past 5 years, as you've seen from my slide here. All right. Okay. From this slide here alone, it can show you the foreign flows over the past 5 years ago. Right. It was all in a negative territory, right, and that caused the Malaysian market to be depressed. All right. Last year was the only time that they turned positive, but unfortunately, when the foreign flows were positive up to August, our local institutions overwhelmed the market by selling. You know why? Because there was a special withdrawal by EPF, right? In the beginning of in the first half of last year, right? And so it was EPF that was selling down, and it overwhelmed the market, all right? So on top of that, the last few years, there was all kind of political turmoil, right? And I would call it a higher political risk in Malaysia, right? And because of this political risk, that's why there are even our locals themselves are a bit skeptical whether even this current government is stable enough, all right, or is able to come up with policies that's able to provide or attract foreign investors, right? And it is because of this current situation, these concerns, that is where the market is currently. But like what I mentioned earlier, our base case scenario is no. No, we do see the current unity government able to maintain its 5-year mandate, right? So that will provide the stability going forward, right? So yes, we are actually hang on, let me see where's the slide. Okay, okay. So that is the current situation now, all right? So yeah, that's a question for your first answer. My assumption of a recession, okay. We are not actually looking at a recession in the US next year. We are looking at slowing growth, right, going into next year. And there will always be talk of recession here and there, right? There will be noises. And if you look in terms of the time between interest rate swings around, right, and when the market turns, there is almost a 1-year period, right, between when the interest rate started running up last year and as normally about 18 months. So I think we are timing it that way. So taking that as the benchmark within our own assumptions, we think there will be more noises that the recession will take place next year, right? And that's why we are taking the view that there will be a change in terms of the rate direction towards the end of this year, right? Perhaps maybe one you would like to add a bit more further on the rate hike.
Yes, Stephen, thank you for the question. Allow me to reiterate our stance. I think for Fed funds, we are looking at 5.25 to 5%, 5.5%. That's the terminal rate we're looking at. We pretty much updated bank client last month. When we started the year, we were looking at the terminal rate of 4.75%. Now, allow me to share the reason. The reason, as you are aware, the job market, the overheated job market in the US persisted. That's number one. Then number two, inflation continued to surprise on the upside in the US. Hence, on that reason, we are looking at no rate cut this year in the US and Fed funds to peak around 5.5% come June this year. Now, secondly, on the local front, we still maintain the view of another 25 basis point rate hike by our central bank. But so basically, it is a return to the pre-pandemic days as far as OPR is concerned. So now that I'm being clear on the interest rate expectation from macroeconomic front, I'm going to touch a bit on the recession. So yes, I think in the US, we are not there is a possibility for soft landing scenario in the US. What is the reason? The reason is because, as I mentioned just now, the job market, in fact, had really surprised the whole financial market on the upside, in the sense that the US unemployment rate had fallen, I think, to 3.4%. That's number one. Then number two, we have heard a lot of job cuts being announced by tech companies, some of the investment banks, yet they are having 11 million number of jobs opening there in the US. So whatever job cut that we've heard in the news so far is pretty much nothing vis-a-vis to the number of job openings over there in the US. Hence, that explains why we still think that there is a possibility just for a soft landing scenario in the US. Now, for the local front, we reiterate the growth forecast of 4.5%. Hence, we do not see any recession as far as the Malaysian economy is concerned. I hope that answers the question, Stephen.
Thank you, Alex. Thank you, Wan. All right, we'll carry on to the next question from Kai Xuan. A tightening monetary policy usually comes with an economy slowdown. In your opinion, what are the key factors driving demand and pushes companies towards expansion despite high interest rate?
What do you like to take that before maybe I add to that?
Yeah, I think you better take that, Alex. I think I don't have the mandate to talk about specific companies. I mean, I can add on the macro front.
Okay, maybe just talk more on the macro front. First, I'll talk about the company.
Okay, I think at the end of the day, interest rate is one of the factors in generally speaking, it's one of the factors that determine the rate of investment. But in the context of the Malaysian economy, as I mentioned earlier, even if there is another 25 basis point rate hike, we are just about to return to the days of pre-pandemic, i.e., to me it is a interest rate normalization in Malaysia rather than tightening. So that should not be preventive of corporate investment, theoretically speaking, because we're at 3%. Now, reason number two is this. If you look at the amount allocated for development expenditure as far as the retail budget is concerned, we noticed that the amount allocated for development expenditure actually increases by a margin of 2 billion to 97 billion. So once those expenditure are being translated into the ground, then this is where corporates might be doing some investment in terms of capex, depending on which sector you are. For instance, EV is one of the things that is being championed these days, with target of 10,000 charging instruments. So that could be one of the things. So the point is, in conclusion, yes, interest rate is just one of the factors, but if there is a growth potential in any sectors, then we believe that investment might flow into that. I mean, that's on the macroeconomic perspective that I can address lah on this question. Good. Back to you, Alex.
Okay, thanks very much, Wan. Actually, I just want to highlight that for Malaysia, we are not looking at high interest rates. Last year, yes, of course, because of the drop in our currency and also the supply chain disruptions that took place in China, right? But this year, we are looking at slower increase in terms of interest rate growth, right? In fact, as what Wan mentioned earlier, if the subsidies largely maintain, we should be able to keep our inflation in order, right? Now, interest rate, all right, we are looking at another 25 basis point hike, right? And then I think it's moving towards normalization, right? Not something that is extraordinary if you were to look at during pre-pandemic times. But be that as it may, you are right, Kaizuan. Some property companies are not launching their condos or their properties first until the interest, the 25 basis point hike has taken place. That's what I've talked to some of the corporates. But many of the others, like Marsing, they're still going on as normal. All right. And in terms of expansion, I think it's quite selective for companies. Construction companies, if you take the MRT3, of course, construction loans you definitely need to take on, right? That will have to take place because MRT3 is something that's needed, right, to provide the necessary linkage, the ring that connects all the other MRT lines, right? So and you look at IT in Penang, Intel is coming to expand. So there are selected niche and sectors that is going to drive the economy. And that's why we are looking at 4.5% GDP growth, right? Yes, it's slowing down from 8 to 9% last year, right? But it's still a decent growth, 4.5%. And you compare with with global rates, and you compare with US, Malaysia looks pretty good. Yeah.
All right, thank you, Alex. There's two more questions. Next question will be from Gary. What is your view on Pharma Niaga that went into PN17?
Well, we do have an analyst that covers the healthcare sector, and we do have companies like Duo Pharma, right? But we have never covered Pharma Niaga for a long time, right? I think we do not have the kind of relationship with the company, and as far as I can tell, AmBank did not provide any banking facilities for them. So we did not have to provide any NPL for Pharma Niaga. Thank goodness for that. Yeah. Of course, the reason is because of the COVID. You just read is because of the COVID vaccine. They bought a lot of it, and now nobody wants to take the booster shots, right? So of course they are now gone into and now they have to do a write-off, and that's caused it to go into PN17. Okay.
All right, thank you, Alex. The next question will be Shen Chong Xie. What is your view on Mr. DIY and My News?
For Mr. DIY, our analyst is positive on it. All right. We have a buy call. The simple reason is you just read our reports. The simple reason is because they are expanding their branch expansion, right, is there, and it will continue to drive their group going forward. For My News, I have to refer back to my analyst for My News. I cannot remember. My view is that it is more of a whole, right? I think they are struggling in terms of some of the outlet. They are not doing too good.
Okay. All right. So far that's all the questions. If there's no more questions, we shall call it a day. Thank you so much for participating. Thanks for your questions. Thanks, Alex. Thanks, Wan, for your sharing on the insights. Yeah, so if you wish to get more research reports or the further event info, please join our Telegram channel, which I already posted it in the chat box. Otherwise, happy investing, and we will see you in the future event. Thank you.
Okay, thank you.
Thank you.